Imagine a world where the demand for data is, well, truly insatiable, where AI-driven connectivity is just starting to reshape everything.
Hmm.
What if we told you the company building the very backbone of this digital future, the world's largest digital landlord, might also be a leveraged giant facing some of its toughest
Good.
tests?
Yeah, that's the tension, isn't it?
Exactly. Today, we're taking a deep dive into American Tower Corporation, or AMT. It's a global real estate investment trust, and we want to unpack its fundamental nature, its financial strength, and, what it all means for its future value.
Right. Our mission here is really to sift through the analysis, the financials, the market data we have as of June 22, 2025.
Okay.
We want to give you a clear, informed perspective on AMT. We'll explore if that current share price around $217.48 as of June 19th really lines up with its intrinsic value.
And critically.
And crucially, what assumptions you, as an investor, would need to make to actually justify that price today.
Okay, so to really get a handle on American Tower, let's start with the basics.
Chapter 1. Business Understanding. So at its heart, American Tower operates as this digital landlord, but on a huge global scale.
Right.
They're independent owner, operator, developer
Yeah.
of communications real estate. Think towers, but also other systems, all designed for multiple tenants.
And who are these tenants?
Well, their main business is leasing that vertical space on their infrastructure to wireless providers, broadcasters, data providers, even government entities. And as a REIT, a real estate investment trust, remember, they own income-producing real estate and have to pass most profits to shareholders.
Got it. So how does the revenue break down?
It's pretty concentrated. Property revenue makes up about 98%. That's the core, high-margin, recurring income from tower leases, distributed antenna systems, data centers.
And the other 2%.
That's services revenue. It's smaller, mostly U.S.-focused, things like site application help, zoning, construction management. It sounds small, but it's strategically important.
How so?
Kind of greases the wheels for tenants. Makes it easier for them to deploy or upgrade equipment, which then feeds right back into that high-margin property business. Reduces friction, drives growth.
Okay, so it sounds like they've really broadened out from just, the classic cell tower image. How have their key products evolved?
Absolutely. Tower leasing is still foundational, obviously, providing that essential vertical real estate for antennas. But yeah, the portfolio has changed a lot.
Like what?
Well, beyond towers, they offer distributed antenna systems, DAS, and small cells. Think of these as mini antenna systems. They boost coverage in really high traffic spots like stadiums or dense city centers where big towers just aren't practical.
Right.
And the key thing here is their neutral host model. It means multiple carriers can use the same shared infrastructure. Super efficient and really critical for rolling out 5G, which needs denser networks.
Makes sense. And you mentioned data centers.
Yeah, that was a really profound strategic shift. Came with the CoreSite acquisition back in 2021. That brought them into data center facilities and interconnection. So now they offer colocation, power, cooling, crucial interconnection services within U.S. data centers.
So it's not just diversification.
No, not at all. It's about positioning AMT as this comprehensive digital infrastructure provider. They're anticipating the convergence, the blurring lines between wireless and wireline networks. Think about the huge demand for low latency processing, quick response times needed for AI, autonomous vehicles, the Internet of Things, all happening at the edge of the network, closer to users.
Right, processing closer to the source.
Exactly. American Tower is building itself into the indispensable backbone for that whole data ecosystem, from the device right up to the cloud.
That's a really significant expansion of their role. So with this evolving portfolio, how does American Tower stack up against competitors, and what's the wider market looking like?
Well, they're the undisputed global leader, one of the largest REITs by market cap, easily.
The scale is huge.
Yeah, immense. Over 225,000 communication sites, 28 data centers, spanning something like 25 countries across 5 continents.
Wow.
Yeah. The U.S. and Canada are still about half their revenue, but they've had big operations in India, Latin America, Europe, Africa.
Yeah.
This global scale is a core strength.
How does that help them?
It gives them a unique value proposition. They can be a single, streamlined partner for multinational carriers trying to deploy complex networks across borders. It simplifies things hugely for those big customers. And that scale is also a key risk mitigant. It insulates them if one market hits a rough patch.
And the overall industry trend? Still growing.
Oh, definitely. The industry is riding this powerful long-term tailwind. driven by, exponential growth in mobile data consumption and the global 5G rollout.
So 5G is a big driver right now.
Absolutely. Major U.S. carriers are rapidly upgrading their mid-band 5G equipment. That fuels significant leasing amendment activity carriers, adding more gear to existing towers, and demand for new sites, too. Application volumes have been climbing consistently, which shows strong underlying demand.
And
The long-term driver is densification. 5G just needs more sites, closer together. That creates a multi-year runway for organic growth. And then you have emerging tech like AI, edge computing. Those are future catalysts stacking on top.
What about competitors? You mentioned Crown Castle, SBA.
Right, in the U.S. cell tower market, it's what you'd call a rational oligopoly,
Meaning?
meaning it's dominated by a few big players: AMT, Crown Castle, CCI, SBA Communications, SBAC. They tend to compete more on scale and service quality rather than just slashing prices. It's generally stable.
I heard Crown Castle made some changes recently.
Yeah, they did. They're pivoting strategically, divesting their fiber assets to become more of a pure-play U.S. tower company, which, interestingly, kind of validates AMT's long-standing tower-centric strategy that's delivered consistently strong results. Some competitors, like CCI, have even taken big write-downs related to fiber assets recently.
In regulations, sounds like a complex area.
Incredibly complex. You've got stringent federal rules from the FCC, FAA, covering environmental impact, historical sites, aviation safety, then state and local rules for zoning, permits.
That sounds like a headache.
It is. But it's not just a hurdle. It's actually a massive barrier to entry. Building new towers is incredibly slow, expensive, and there's no guarantee you'll even get approval.
So that makes their existing towers more valuable.
Dramatically so. Their existing permitted assets are gold. The barriers to entry are exceptionally high across the board. You need huge amounts of capital, you face years-long regulatory battles, and prime locations.
I see.
They're scarce and mostly already locked up by incumbents like AMT.
So a new player can't just jump in easily.
Not really. How do you compete with an existing footprint of over 225,000 sites? You just can't replicate that quickly or cheaply.
So all this adds up to a competitive advantage, a moat.
Exactly. A wide and durable economic moat. First, there's brand strength. They're the global leader, a trusted essential partner. Then, powerful cost advantages and economies of scale. The initial cost to build a tower is substantial, right? But the incremental cost of adding a second, third, or fourth tenant, minimal.
So the margins jump way up.
Dramatically.
Yeah.
Think of it like this. The first tenant pays for the tower's existence. Subsequent tenants are almost pure profit. That's inherent operating leverage.
What else?
Network effects and switching costs. They're extremely high for tenants. Churn, meaning customers leaving, is incredibly low, typically under 2% a year, if you exclude the specific T-Mobile Sprint merger impact.
Why so low?
Because moving all that sensitive equipment from one tower to another is a massive logistical and financial headache for carriers. It creates a very sticky customer base.
Makes sense.
And finally, just their unique assets. Over 225,000 non-replicable communication sites in strategic locations. Plus, the CoreSite data center integration adds another whole layer. It's truly unmatched.
It's really clear how those structural advantages feed into their profitability and stability. But before we get deeper into the financials, if you're finding this deep dive valuable, remember to like and subscribe to the Stock Analytics AI YouTube channel. Members get priority deep dives on tickers and can add stock suggestions for future videos in the comments, which we'll definitely pick up.
Absolutely. Now, moving on.
A company can have incredible assets, but like you said, success often comes down to the people steering the ship. Let's talk about leadership.
Okay. Chapter 2. Management Evaluation. American Tower's leadership generally gets good marks, especially for strategic continuity. Stephen Vondran became CEO in February 2024, taking over from Tom Bartlett.
Was he an outside hire?
No, and that's key. Vondran's a company veteran, joined way back in 2000. He previously ran the U.S. Tower Division and CoreSite, so it was an internal promotion.
Signaling stability.
Exactly. Thoughtful transition reduces operational risk. Their communication transparency is also considered high comprehensive investor relations, detailed SEC filings. They talk about being guided by ethics, integrity, accountability.
Standard corporate talk, or is there substance?
Well, one tangible example of responsiveness is how they changed their executive compensation in 2024. They added relative total shareholder return, TSR, as a new performance metric for long-term incentives.
So tying pay more directly to how the stock performs versus peers?
Precisely. Directly aligning executive pay with shareholder outcomes. That's generally seen as a positive governance move.
Okay, if we connect that to the bigger picture, capital allocation,
hmm
that's where management really shows its hand, right? How's AMT been deploying its capital?
Management calls their approach disciplined and focused on accretive investments, meaning investments expected to actually add to per-share earnings over time.
So where does the money go?
Organically, it's mainly supporting those 5G deployments we talked about. But their M&A strategy has seen a really interesting evolution.
How so?
Well, the recent sale of their India operations to Brookfield, that's a fundamental shift. It reverses an earlier growth at any cost kind of mentality in some emerging markets.
So pulling back from higher risk.
Seems like it. It shows a willingness to prune assets that may be offered lower quality or higher risk, and instead focus on better risk-adjusted returns in developed markets like the U.S. and Europe.
And Coresight.
That 2021 Coresight deal was the opposite, a bold, transformative addition, really positioning them for that wireless wireline convergence trend. It was a big bet.
What about returning cash to shareholders? Dividends, buybacks?
Well, as a REIT, they have to distribute at least 90% of their taxable income as dividends. And they have a stellar track record here.
How stellar?
Increased the dividend 15 times in the last 5 years. That's a compound annual growth rate of over 9%. It's a primary way they return capital.
Any share buybacks? Some companies do that too.
Not significantly, recently. Unlike some peers, actually. They seem to be prioritizing balance sheet flexibility and putting capital towards those organic growth opportunities, or M&A, which they presumably see as higher return.
Which seems prudent given their debt levels.
Exactly. It makes sense given the leverage.
Okay, one more thing on management return on invested capital, ROIC. How are they doing there?
That's a key metric for judging capital allocation skill, right?
Yeah.
And AMT does well. Their trailing 12-month ROIC is 7.6%,
How does that compare?
significantly higher than the average real estate sector ROIC, which is around 2.8%, shows superior economics.
I see it dipped a few years ago.
Yeah, it dipped to about 4.5% in 2022. That was mainly due to digesting those big acquisitions, Coresight and Telxius, but it recovered strongly to 7.7% in 2024.
Suggesting those deals are paying off.
It suggests the investments are maturing and starting to generate the returns they expected. Crucially, their ROIC is consistently exceeding their weighted average cost of capital, or WACC, basically, their cost of funding,
Which is estimated around...
around 6.5% to 7%. So if ROIC is higher than WACC, it means they're effectively creating economic value for shareholders. They're earning more on their investments than those investments cost them.
That's a great overview of their strategic decisions. Now, let's really dive into how all these choices translate into the hard numbers on the financial statement.
Okay, Chapter 3, Financial Analysis. First off, scale. American Tower's market cap is roughly $101.8 billion as of June 2025. That puts it firmly in the mega cap leader category for global REITs.
Huge company. What about revenue growth? You mentioned 5G.
Right. Revenue growth has been strong overall, but it has been decelerating over the past 5 years. It went from about $8 billion in 2020 to just over $10.1 billion in 2024.
Was there a spike in there?
Yeah, 2021 saw a big jump over 16% growth, but that was mostly acquisition-driven, mainly from Coresight and Telxius.
And the slowdown since then?
A few factors. Headwinds from a strong U.S. dollar impacting international results, that T-Mobile Sprint customer churn we mentioned, and also their deliberate strategic pivot towards slower, but perhaps steadier, growth in developed markets. The focus now seems clearly on the quality of growth, not just growth for growth's sake.
Okay. Profit margins. You said they benefit from leverage.
Exceptionally strong margins. It's a direct reflection of the business model's powerful economics. For the trailing 12 months, get this, gross profit margin is 74.6%, operating profit margin 44.6%, net profit margin 22.3%.
Wow, those are high.
World-class margins, driven by that high operating leverage we talked about. Once the tower's up, adding more tenants costs very little, so that extra revenue drops almost straight to the bottom line.
And free cash flow, the actual cash the business generates.
It's been a bit volatile, but the long-term trend is definitely upward. It hit a record high of $3.7 billion in 2024, up from $2.85 billion in 2020.
Why the volatility? I see a dip in 2022.
Yeah, that sharp dip in 2022, down to $1.8 billion, was due to peak capital spending and integrating those big acquisitions. But the powerful rebound since then really validates the cash-generative power of their assets, shows they can reliably convert that revenue into actual distributable cash.
Now let's talk stability. For a company this size, the foundation needs to be solid, especially considering, well, the debt.
Right. Stability first. American Tower has a long proven track record of consistent earnings. They perform reliably through different economic cycles. It speaks to the essential non-discretionary nature of their services.
People need their funds to work, recession or not.
Pretty much. Their financial predictability is so strong that independent analytics consistently give them top scores for growth and operational cash flow generation.
Okay, but now the debt. That's the big caution point, isn't it?
It is the most significant one, yes. Their trailing 12-month debt-to-equity ratio is 13.0. That's high. Total debt is around $36.86 billion as of the first quarter of 2025.
A double-edged sword, you said.
Exactly. It fueled their global expansion. Definitely amplified their return on equity, which is an impressive 35.3%, but it absolutely introduces considerable financial risk.
Meaning?
Meaning a highly leveraged company is just more vulnerable if interest rates spike or if their operating income dips unexpectedly. Management knows this, of course.
What are they doing about it?
They're actively managing it, refinancing debt to push out maturities, locking in fixed interest rates where possible, trying to mitigate that interest rate risk.
What about their current ratio? I saw it was pretty low, like 0.45.
Yeah, TTM current ratio is 0.45. Now, for a typical manufacturing company, that might be a red flag, signaling trouble paying short-term bills.
But not for AMT.
Not necessarily. For a REIT-like American Tower with highly predictable recurring cash flows from those long-term leases, it's less concerning. They just don't need a huge pile of immediate cash sitting around for daily operations like some other businesses might.
Okay, and finally back to the dividend. Stable. Growing.
Absolutely core to their shareholder return story. Unwavering commitment. Increased it 15 times in the last 5 years, that 9.07% compound annual growth rate. It's a direct reflection of their strong growing cash flow.
So wrapping up the financials, strong margins, growing cash flow, but significant leverage. What does all this mean for its valuation? Are investors getting a fair price, or is the market already baking in all this good news?
Right, let's transition to valuation analysis, where things get really interesting. First, relative valuation. Look at the price-to-earnings ratio, the PE. It's around 55 as of mid-June 2025.
How does that compare?
That's a significant premium to the average REIT sector PE, which is closer to 10.6x. So the market clearly recognizes AMT's superior growth prospects and that strong economic moat we discussed.
But compared to its own history?
That's the interesting part. It's actually slightly below its own historical averages. Its 3-year average PE is around 62, 10 years around 58. So there's been some modest compression.
Why might that be?
Possibly the market pricing in some of those near-term headwinds, like the T-Mobile churn we keep mentioning, or maybe broader concerns about interest rates affecting REITs.
Okay, PE is one way. What about intrinsic value? Like, what's the business really worth based on its future cash flows?
Right. That's where discounted cash flow, or DCF, analysis comes in. It's a cornerstone of value investing.
Explain that simply.
Think of buying an apartment building. You wouldn't just look at this year's rent, right? You'd project all the rent you expect to collect over its lifetime. Then you discount that future cash back to what it's worth today. Because a dollar tomorrow isn't worth as much as a dollar today.
And the discount part depends on?
It depends on your required rate of return, or what your money could earn elsewhere. For a company that's roughly the weighted average cost of capital, the WACC, it's the hurdle rate the investment needs to clear.
So what do DCF models say about AMT?
Well, this is fascinating. Educational DCF models spit out a really wide range of values. One model might suggest $106.36 per share, implying it's significantly overvalued right now.
Wow, that's low compared to the $217 price.
Right, but another base case model might come in around $192.92, suggesting it's still modestly overvalued, but closer. Other, simpler models might even suggest it's around fair value, near the current market cap.
So DCF isn't a magic number generator?
Not at all. It highlights that valuation is an art, not a science. It's incredibly sensitive to the assumptions you plug in.
Which assumptions are most important?
2 key ones. The discount rate. The WACC we talked about, estimated maybe 6.57% for AMT, relatively low due to its stable model but offset by high debt. And the terminal growth rate, how fast do you think earnings will grow forever after your forecast period, maybe 4% long-term, shouldn't exceed overall economic growth.
And small changes there make a big difference.
Huge difference. That's why the core question for you as an investor isn't what does the DCF say, but rather, what do I have to believe about American Tower's future growth and risk for today's market price of $217.48 to make sense?
That's a great breakdown of the financials and the valuation puzzle. Now let's shift gears slightly and look at what the broader market thinks. What's the sentiment out there?
Okay. Chapter 4, Market Sentiment. So what's the collective wisdom of Wall Street saying? Overwhelmingly positive, actually.
Really, even with the valuation concerns.
Yeah. The consensus rating from analysts is moderate buy or strong buy. Get this, 31 out of 39 analysts covering the stock recommend buying it.
That's pretty strong consensus. What about price targets?
The average 12-month price target falls in a range of about $225 to $251. That implies, roughly 15% upside from the current price, around $270.
But averages can hide things.
Exactly. You have to look at the range, and it's remarkably wide. The high target is way up at $278.25, but the low is down at $169.
$169.
Who's that bearish? That particular target comes from Morgan Stanley. It likely reflects more pessimistic views on things like the impact of T-Mobile churn or maybe the sensitivity to interest rates. So the takeaway is, don't just follow the herd. Understand why there's such a wide range. Be cautious of blind consensus.
How about recent news and media coverage? Anything surprising?
Pretty balanced, actually. Lots of positive focus on the good stuff, 5G growth, the data center and edge computing angle, their disciplined capital allocation.
And the cautions?
The usual suspects. Customer concentration risk, the T-Mobile Sprint churn impact through 2025, and that high debt making them vulnerable to interest rate moves. No real hidden bombshells or scandals. The key investment points are pretty well understood and debated.
Okay, beyond analyst opinions and news headlines, what do the market indicators themselves tell us, like short interest?
Short interest is quite low, around 1.11% of the float. That means very little smart money is actively betting against the stock price going down.
Which supports the positive analyst view.
It corroborates it, yeah. Reinforces that perception of AMT as a stable, blue-chip kind of company. Not a lot of controversy driving short sellers.
And technicals, moving averages.
Looking at the chart, the stock is trading just slightly above its 50-day moving average right now. That suggests maybe some consolidation, not strong momentum, either way in the short term.
And the longer-term view.
Comfortably above its 200-day moving average. That's generally seen as a technically bullish signal for the longer term. It did dip below that line late last year, but it recovered, showing resilience and that buyers stepped in.
Fascinating. So the market seems generally positive, but aware of the risks. Now let's talk about who actually owns American Tower. What does the ownership structure tell us?
Right, Chapter 5, Ownership Structure. This is revealing. American Tower is overwhelmingly owned by large institutional investors. We're talking somewhere between 79% and maybe over 92% of the stock.
Who are the players?
Heavy concentration among the big passive index funds, Vanguard, iShares, SPDR. Vanguard alone holds over 11%. It's huge.
So a lot of index buying.
A lot. But you also see sophisticated active REIT specialists in there, like Cohen and Steers. Their presence is a strong vote of confidence from investors who really, really know this specific sector.
What's the impact of all this institutional ownership?
Well, it provides a stable, long-term shareholder base, which is good. But it also means the stock price can be influenced by broad market flows in and out of index funds, or REIT funds generally.
Makes sense. What about insiders? Management? Directors? Are they buying?
That's the interesting counterpoint. Insider holdings are very low, around 0.10%. Tiny.
Okay.
And more importantly, there's been a consistent pattern of selling by insiders, likely for normal financial planning, diversification, taxes, But critically, there have been no open market purchases by insiders in the last 12 months.
Even when the price dipped?
Even during periods of price weakness. And the old Peter Lynch saying,
insiders might sell for any number of reasons, but they buy for only one.
They think the price will rise. Exactly. Right. So the absence of any insider buying, even when the stock looked cheaper, is a subtle but important bearish signal. It suggests those closest to the company don't see it as deeply undervalued right now.
That's a really telling detail against the bullish analyst consensus.
It is. It's something to weigh. And one last point on ownership. The concentration is high. The top 10 institutions own a significant chunk.
Which means?
It implies there's regular dialogue between management and these major shareholders. They likely have significant influence on corporate strategy, maybe even things like those recent changes to executive compensation we discussed.
Got it. Okay, every investment involves risk. Let's put it all together.
Chapter 6, Risk Assessment. Time to look at the vulnerabilities and opportunities side by side. Kind of SWOT analysis, strengths, weaknesses, opportunities, threats.
Let's start with the strengths. We've covered a lot.
Right. Global market leadership, 225K plus sites. A really durable business model, long-term leases, often with inflation protection built in. Superior economics, that high operating leverage, world-class margins, a wide economic moat, those high barriers we talked about,
Yeah.
capital regulation, scarcity, and they provide essential infrastructure for 5G and the whole digital economy. Hard to argue with those.
Okay, weaknesses. We touched on debt.
Definitely. High customer concentration is one. They rely heavily on a few major wireless carriers in each key market. That gives those customers bargaining power.
And the leverage.
High financial leverage is the big one. Makes them sensitive to interest rates, like we said, and really demands flawless execution. There's less room for error. And also, foreign currency exposure from their international operations can impact results.
What about opportunities looking ahead?
Big ones. 5G network densification is a multi-year organic growth driver. The data center and edge computing play through CoreSite is a huge convergence opportunity. Potential for new customer segments, maybe enterprise customers using private networks, IoT applications, public safety networks, and that strategic capital allocation selling India lets them focus firepower on higher return developed markets.
And finally, the threats. What could go wrong?
Carrier consolidation and churn is a current headwind, specifically the T-Mobile-Sprint merger impact continuing through 2025. The interest rate environment is a constant threat for a leveraged company, potentially increasing financing costs and pressuring valuation.
Any technological threats? Satellites, maybe?
Technological disruption, like low Earth orbit, LEO, satellite networks, think Starlink is out there. Right now, it seems like a minor threat, maybe impacting niche rural areas, but it's something to watch long term. Could it offer alternative connectivity? Possibly. And finally, regulatory and geopolitical risks, changes in zoning, permitting, or international trade policies, like those potential U.S. tariffs in 2025.
That's a comprehensive view. It's fascinating how some of these threats aren't just internal company issues, but external factors like macroeconomics and geopolitics.
Exactly. As a highly leveraged REIT, AMT is inherently sensitive to macro shifts, especially interest rates. Rising rates obviously increase their borrowing costs and can put pressure on their valuation multiple.
But there's nuance there, right?
There is. The reason for rate hikes matters. If rates rise because the economy is strong and driving data demand, that underlying strength can potentially offset the higher financing costs. The worst case for them would be stagflation, high rates, and a stagnant economy.
And management is trying to mitigate this.
Yes, by locking in fixed rates on their debt and extending the average maturity out to over 5.7 years, that creates a buffer. And the fact the Federal Reserve is currently signaling potential rate cuts in mid-2025 is generally favorable for a company like AMT.
What about those tariffs you mentioned? How could that impact them?
It's an indirect but potentially material threat. If the U.S. imposes significant tariffs on telecom hardware imported by their tenants, the carriers.
It makes the carrier's equipment more expensive.
Right. Even if some key components are exempt, other core network gear might face higher costs. That pressure could force carriers to slow down their 5G network deployments or cut back on capital spending.
Which directly hits AMT's growth.
Exactly. Fewer new leases, fewer high-margin lease amendments. It's a knock-on effect.
All right, we've covered a tremendous amount of ground. Let's bring it all together for the conclusion.
Okay, Chapter 7, Conclusion. So, after this deep dive, what's the synthesis? What have we found about American Tower?
What's the bottom line?
Well, our analysis really paints a picture of an exceptional, high-quality company with undeniable strengths, but one that's trading at a valuation that seems to already reflect much of that quality, alongside some clear near-term headwinds.
Let's recap the bull case first. Why invest in AMT?
The bull case rests firmly on that unassailable economic moat. They are the global digital landlord, 225,000 plus unique, non-replicable assets, protected by formidable barriers to entry. Their business model is incredibly durable, predictable, recurring, inflation-hedged cash flows from long-term contracts.
And the economics.
Superior economics, high operating leverage, world-class margins. Plus, they're plugged directly into massive secular growth trends, data consumption, 5G, AI, edge computing, and you have a seasoned, disciplined management team at the helm. It's a compelling story.
Okay, now the bear case. What are the main concerns?
The bear case centers on that highly leveraged balance sheet. It creates vulnerability to interest rate shocks and just demands near-flawless execution. There's customer concentration risk. There are those near-term revenue headwinds from the T-Mobile Sprint churn expected through 2025. And as we discussed, the current market valuation appears full, maybe even overvalued, depending on your assumptions.
So putting it all together, what does this mean for you as an investor considering AMT right now?
Let's revisit the valuation summary. Remember those educational DCF models? They gave a really wide range from maybe $106 up to a base case around $193 per share. Other methods suggested something closer to fair value.
Highlighting the sensitivity to assumptions.
Exactly. DCF is a framework for thinking, not a precise answer machine.
So your concluding outlook.
Our concluding outlook is this. The current share price of $217.48 as of June 19, 2025, trades at a premium to basically all the calculated intrinsic values,
Yeah.
especially those based on more conservative assumptions.
Mean.
Meaning it suggests the stock is likely fully valued, perhaps even overvalued right now. For you to justify buying at this price, you'd really need to believe in a more optimistic future than our base case assumes, maybe significantly higher long-term growth from new technologies. Or perhaps you perceive the risks as lower, warranting a lower discount rate.
So not much margin of safety.
At this price, it appears to offer a low margin of safety. That's the cushion between intrinsic value and market price that value investors look for. American Tower is, without doubt, a high-quality, world-class enterprise with a very bright future. But it seems much of that optimism is already reflected in the current stock price. You are paying a full price for a great business today.
That's a really clear summary. It leaves us with a final provocative thought for you, the listener. Given American Tower's absolutely indispensable role in our digital future, are its unique, tangible assets truly immune to financial pressures and market cycles? Or is even the digital landlord, despite its moat, ultimately subject to the laws of financial gravity? And that wraps up our deep dive into American Tower Corporation. We really hope you've gained some valuable insights, maybe had a few aha moments along the way.
Yeah, absolutely. And just remember, please conduct your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions based on this. This analysis was generated by an AI system purely for educational purposes and should definitely not be considered financial advice.
That's right. And if you enjoyed this deep dive and want more insights like this, please don't forget to like this video and subscribe to the Stock Analytics AI YouTube channel. Membership is just €4.99 a month, and members get priority deep dives on tickers they suggest. Plus, over the next few months, we're actually covering all of the S&P 500 stocks exclusively for members. We love getting your stock suggestions in the comments.
We really do.
Thank you so much for joining us for another deep dive. Until next time, keep learning, keep questioning, and stay well informed.